There's not much in the way of local language. The network coverage may not be terrific. The scripts are complicated. The sequences are complicated. There's a whole bunch of stuff around this that's pretty hard for our set of clients, and it's not really clear that the organizations, the companies that are developing these technologies are particularly sensitive to the needs of our kind of clients. And we feel there's great room for some philanthropic capital in this area. There's another approach. It's not necessarily even a technology-based approach for looking at dramatically changing the cost structure of microfinance. And that is to build partnerships among organizations that each specialize in very different parts of a value chain. Basically, you're starting to see around the world a whole series of different kinds of alliances that you would not have seen even 5 years ago to, again, develop distribution channels that get financial services out into very poor sorts of neighborhoods. And you see here's just a list. Retail banks going down market, hooking up with MFIs, retail banks and distributors. This Bansefe is a big apex bank in Mexico. Bimbo is the largest bread manufacturer, goes around on trucks. Bansefe is putting loan officers on trucks that drive around to small communities. You see insurance companies, telecoms, some of this mobile phone technology. In any case, what you're starting to see is a lot more variety in the kinds of alliances and relationships that allow financial services to piggyback on top of distribution channels that are being built by retailers that actually get out into rural communities for one reason or another. All of this helps because it drives down your transaction costs structurally. It takes big bites out of your transaction costs and allows you, in many cases, an individual relationship with clients. You have in the self-help group movement, the connections with banks, the connections with franchisees who do some of the group maintenance. You have all sorts of varieties of ways in which you have a less sort of monolithic, highly structured model of a single organizer of the service who does everything from A to Z. And you're starting to see a lot more variety in the kinds of relationships and the potential of those relationships to dramatically reduce costs. Just some more kinds of partnerships. So I'd like to start to move toward the end of this by looking at the other three areas. We spent all this time on the business model because actually we think that that's pretty essential. We think that if we can help push hard on the way we organize and structure access to financial services, that we can actually have a huge impact by getting costs down that then empower so many other good things to happen. So that's why we spent more time on it. We also have three other areas that we're working on. One is the whole area of product offerings. A sense that a lot of the products out there today are quite rigid, may not in fact be products that are most highly demanded. And so we see that there's some work to do still in the product area. I've got three products up there: savings, insurance, and credit. The payments we sort of covered in the business model stuff. So basically, it seems like there's a fair amount of work to do in the whole area of deposits on figuring out how one builds in the sort of contractual mechanisms that help people save in a disciplined way. Because that's one of the things that you find, we've been finding back in the days when Bill and I were at Acción. You found that people actually kind of liked those